Dear friends of Grey Rhino, I'm very happy to be seeing y'all once again.
Hi, Kek Wee. Very happy to see you again today. I'm so excited that we can learn from you and from your experience how to invest wisely for the next many years for all of us.
Good to see you, Adi.
Good to see you, Kek Wee. And today, I wanted to really ask you about treasuries, because I think for the past few weeks, we have been reading and also listening to the news about what happened in Treasury Yield, and it affects some of the asset class, and I think it share market as well. So that's why maybe for the benefit of everybody, we would like to know first, what are treasuries actually, Kek Wee?
Sure, Adi. Let me show you by a slide. Okay, so there it is. So that's the US Department of Treasury. Okay, so what are treasuries? Actually, treasuries are debts that is issued by the US Department of Treasury. In other words, the US government. Okay, so they are like the IOU because they need to borrow money. Because US has been in the deficit spending for a long time, right? Hence, it needs to be borrowing money to be financing its spending, and that's where you need to issue treasuries. And when you issue treasuries, you issue to this is currently the holder of the treasuries from 2012 to today. Okay, largely put, the Federal Reserve, which is the central bank, the foreign investors, which are the other countries like China, Japan, and the private investors like the mutual funds, the banks. Okay, so these are the buyer of the treasuries, which in turn will then give money to the US government. So that is a function of treasuries.
Thanks, Kek Wee, for sharing and explaining about what are treasuries. So my next question is actually about what has happened for the past many months, I think, about the treasury yield. Because when I observe the news, right, the treasury yield has been going up and down for the past few months, especially when Federal Reserve do some certain action or even after their meetings. Would you mind to share with us what has happened actually?
Sure, Adi. Let me show a slide. Okay, I guess this is what you meant. Where this is from 2018. So the yield of the treasury was high, and then it declined a lot during the COVID-19 period, and then now it's rising, and it kind of peaked at this point. It peaked on the 31st of March this year at about 1.745%, and since then it's been progressively drifting down. Now it's about 1.5%. Okay, so what's the reason that the yield has been coming down despite inflation being more than expected? Okay, I think the widespread reason people was sharing is that because the Federal Reserve thinks that the inflation is transitory, which means after this initial blip, inflation will come down and interest rate will come down. Okay, and I think people buy into the story, and then hence they think inflation is going to be a passing cloud and interest rate has come down. However, I think there's more than that. Okay, let me share with you two other reasons which are probably not commonly heard. Okay, the first one is that since end of last year, as everyone knows, the Federal Reserve is actually flooding the whole system with liquidity, right? Which is why the stock market, after a 2-month drop, start to skyrocket. And in March this year, on the same day, 31st of March, the same day as where the yield peaked, was the day where the exemption of the US banks having to keep capital requirements for these deposits that they take in. So after 31st of March, what happened is that this bank can't take in that liquidity, can't take in these deposits, or they got to reduce taking in. And what happened is, since people can't put their money in the bank, it go outside the banking system. Like it goes to funds, and hence it's flooded with liquidity. And worse still, the US Treasuries has also borrowed more than what they needed. So they actually had the Treasury actually borrowed a lot of money, and as at end of last year, they had about 1.6 trillion of money that's not being spent. And they have a debt ceiling to be kept to. And hence by August this year, they need to reduce it to below 500 billion. And that's what's happening. So what's the liquidity that's the savings that's held at treasuries has been gradually moving into the markets. And hence there's excessive liquidity in the markets since the bank now cannot take it in because the exemption from capital requirement is now being stopped by the Fed. I believe all this excess liquidity, part of it would have found its way to treasuries, to be buying these treasuries. And hence this excess demand has kept the yield low. And the third reason is because prior to this rise in interest rate, right, a lot of foreign countries, let's say Japan and European institutions, after cost of hedging, in fact, the yield on the treasury after hedging is lower than their domestic treasuries, and it wasn't attractive. However, at the start of this year, when the US Treasury yield rose, in fact, the cost of the yield after hedging of these treasuries has in fact risen above their own domestic treasury yield. And hence it became attractive for this foreign institution to be holding this US Treasury. And that created an additional demand. So I think it's because of this demand that has really been capping the treasuries. I think not so much because of this inflation story. Because the truth is inflation has indeed been more than expectation. So I think with this, well, at least part of the story, the liquidity story, is not a permanent story. It's going to be temporary. And I think somewhere around end of August, we probably will see this liquidity starting to dwindle. And hence I say that well, it's probably good to take some precaution if investors have not already to higher interest rates. So that's my view of it.
Understand. Thanks, Kiwi. And then I think the important part is that what is the correlation on this yield at the moment to the asset class that is available in the market, and what can we expect as an investor so that we can really have a wiser move into the future?
Okay, I also prepared a slide. Give me a minute. Okay, I put a simple equation here, hoping to help people understand better. Okay, so you're saying that let's say if interest rates, how does it affect prices of assets? Okay, for productive assets, say like equities, bonds, real estates, this equation holds. So at the numerator is growth rates, and the denominator is interest rates. So you can do a simple, so basically it's a series of cash flow, right? The valuation of assets is a series of cash flow. And hence when interest rate rises, which is the denominator, say, look at this number, let me a simple match, right? If denominator rises, what happened to the figure? It will reduce, right?
Yes.
So if interest rate were to rise, in fact, it will be causing asset price to go down, okay? Especially if it rises at a very fast rate. So historically, if inflation stays at around, let's say, about 2% or 2+%, but I think there's not going to be much issue. However, if it climbs substantially higher than that, that's where I think market will be concerned about this denominator, which is interest rates. And they could be, asset prices could come down because of higher interest rates. But bear in mind, it's not just the denominator, there's also the numerator, which is growth. So if the company or the real estate's rental can be growing faster than the interest rate growth, what I mean faster, I mean faster than initial expectation. So if the company is doing very well and it's growing more than expectation, in fact, even in the interest rate environments, the asset price should still be going up. Well, and let's take a look at one part of history, which is 1970s. So in the 1970s was the last time when inflation was raging. And when inflation was raging, in fact, nobody pay much attention to growth because everybody fixed their eyes on the interest rates and inflation. And hence, for 16 years, stock prices did not move up. That was in times of very high inflation. Yeah. So that is generally to your questions. Yeah. So there's two parts to it: the numerator and the denominator.
Mm.
Yeah. So then, if I say, well, what should the person do now? Well, I think rates are likely to go higher from here. Bear in mind that the new government by Joe Biden, is actually favoring fiscal policies, and hence it needs to borrow a lot of money to be able to spend on the economy, which means the government will need to issue more treasuries. Yeah. At the same time, the Fed is currently already talking about tapering. Yeah, although in 2020, the expectation is in 2023. Of course, that is the current projection. Yeah. And then if the supplies of treasury goes up and the demand comes down, rates will likely go up. Yeah. So that is where I think rates will head up. However, I think the Federal Reserve is still likely to be wanting to be very accommodative, to keep a loose monetary policy. And hence, I don't suggest making a big overhaul to the portfolio, but rather we should be making tweaks like I shared the previous time. Yeah, for example, to be reducing assets that where it's currently not making money and their growth is very far out. Yeah. Or in assets where the numerator is not moving, I mean it's not growing. Yeah, and then when interest rate rises, this asset will also be falling. Yeah. So Adi, I hope I answer your question.
Thanks a lot, Kek Wee. I think it gives us all clarity about what has happened, and especially also to give us an understanding what can we do, what are the things that we need to take note moving forward on our investment. And as per normal, I'm thankful for the time, also thankful for the wisdom they already shared with us. Hopefully, you continue gaining wisdom in your investment as well, that you can continue share with us into the future. And also, please keep yourself healthy as well, Kek Wee. Thank you very much.
Yeah, thanks a lot, Adi. You too.
If you'd like to be listening regularly to the Grey Rhino YouTube to gain more financial knowledge and also investment wisdom, do subscribe below to the Grey Rhino YouTube channel and remember to turn on your notification.